Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Baidu's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Baidu is similar to Google, but is focused on the Chinese market, where Google is almost in every country. Baidu is the fourth largest website in the world. It is the second largest search engine behind Google. It has 76% market share in China. 95% of the visitors to the site live in China, 1.6% in the US, and 1.4% in Japan. The word Baidu means 100 times. The company is headquartered in Beijing, China, and was founded in 2000. It started trading in 2005 and can be found on the Nasdaq, Mexican Bolsa, Deutsche Börse, London Stock Exchange, Vienna, Swiss, Lima, Bulgaria, Hong Kong, and Buenos Aires Stock Exchange. It generates 62% of its revenue from selling ad space on its website, similar to Google AdWords. 27% of its revenue is from iQIYI, which is like Netflix, but only available in China. It features original content. It has TV shows, movies, kids programs, documentaries, animations, sports programs, etc. There are 100 million paid subscribers and another 100 million using the free service. Netflix has 200 million members, and Disney Plus has 100 million. The main difference with iQIYI is that it offers a free service with a large amount of content, but if you pay, you receive additional content and premium content. Netflix and Disney Plus do not offer any free services. 11% of Baidu's revenue is from AI, or artificial intelligence, which has the potential to be its leading revenue generator. The company mentions its strategy is to invest heavily in technology and scale its AI cloud business. It currently has 8% of the cloud market share, but it is so much easier to grow different business segments when you have such a large amount of people using your search engine. If a new cloud company came out, even with superior technology, it would be an uphill battle trying to get people to get onto their platform because no one knows who they are. In Baidu's case, everyone in China knows them. So it's a million times easier to attract customers to your cloud service or any other service you offer. To further improve its AI revenue, the company is investing heavily into autonomous driving and the robo-taxi industry. Baidu holds more patents in this category than any other company in China. The CEO recently said, "In 3 years, our AI business may exceed our advertising business." Last month, China has been aggressively cracking down and regulating its companies, which have seen stock prices in Chinese corporations fall dramatically. Many people speculate the reason China is doing all of this is because DiDi IPO'd in the US, even after Chinese authorities didn't want the company to do so. However, money has been flowing into Chinese stocks listed in the US, more than non-Chinese ones. So it does appear there's many smart investors taking advantage of the discounted Chinese stocks. Let's get started with the model. This is a large cap company, 57 billion market cap. They're trading at 164 a share, and they have 348 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have growing free cash flow peaking in the trailing 12 months at 3.1 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also peaks in the trailing 12 months at over 7 billion. Revenue is the sales for the company, and that moves in the right direction from 15.3 billion to 16.9 billion. This is the company's income statement. All their financials are in Chinese yuan. I converted the numbers to US dollars in my Excel spreadsheet. If you want to know the value in US dollars, just divide by 7. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And their gross profit is the highest in the trailing 12 months. It's also really high as a percent of revenue. So it seems like they're becoming more efficient. Their cost of revenue has been growing, but not as much as their revenue has been growing. Below that is operating expenses, and then below that is operating income, which also looks really good at 17.6 billion yuan. They paid 3.2 billion of interest on their debt, and the bottom line of the income statement is their net income, which was 48 billion in the trailing 12 months, 22 billion in 2020, I would just focus on operating income when I look at the income statement. The reason it's so high, their net income in the trailing 12 months, is because of this other income and expense item. The company passed through a $24 billion gain on Kuaishou Technology. This is a streaming video sharing app. A fair value gain is a non-cash item. So that's why I wouldn't look at other income and expenses or net income when I look at the income statement, because it's more accounting. Operating income is a better indicator of how the company's doing. It is good to understand these things, but it's mainly accounting and it doesn't affect the company's core operations. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So in the trailing 12 months, they reported $44 billion of net income, but you can see they only generated $26 billion of cash flow, which is similar to 2020 and 2019. 2018, however, they had their highest operating cash flow year at $36 billion. Even though they're a search engine, so there shouldn't be too much investment in CapEx, they do invest in other areas. They invested $22 billion in 2018, $19 billion, then $5 billion. So you can see they're trying to grow other segments of their business, especially their AI segment. Operating cash flow minus CapEx gives you your free cash flow. And they have a good amount of free cash flow each year. So they do buy back stock. They bought back $3 billion in 2018, $5 billion in 2019, and $13 billion in 2020. But they also issue a lot of debt. In 2018, they issued $42 billion of debt. They did pay down $21 billion. But they also added $16 billion of stock in 2018. I couldn't figure out exactly why they added so much debt and stock in 2018. I do see in 2018 they spent $24 billion in content costs for Ichi. It's so expensive to obtain content. That's Netflix's biggest cost by far. Like if they want to show Seinfeld, it costs a lot of money. And other TV shows and other movies, really popular ones, are really expensive to show their content. Less popular ones are much cheaper, but certain shows, it costs a ton of money. Plus, all these streaming services always have to come out with new content because they want to keep their members happy and staying on the platform. That's a big reason you're seeing Netflix create original content, so they don't have to spend so much money obtaining it from third parties. That's a big leg up for Disney+. They have a ton of original content, so there's a lot of content they don't have to pay for. This is the equity section of the company's balance sheet, and they had $230 billion of equity in the first quarter. But they don't have all the detail in Yahoo Finance. They do have the detail at 12/31/20, $183 billion of equity. They raised 47 billion yuan from selling stock. The company's profits were 3 times that. They generated 135 billion yuan of profit since they started. So they're making a ton of money, this company. Let's look at the capital structure. They have 35 billion of equity, 12 billion of debt. They're 74% equity, 26% debt. But their net debt is negative 12 billion, so they could pay off all the debt with the cash on their balance sheet and still have $12 billion of cash left over. It's almost like they have no debt because they can pay off all the debt if they want, but they don't want to. They want to use that cash to grow the business and for other reasons. Their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 120 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $105 billion. We divide that by 348 million shares. And we get a calculated stock price of 301. They're trading at 164, so they're trading at a 45% discount. It's a strong buy according to the model. The way I grew their free cash flows was based off of the company's projections of the future and based off of analyst projections. I thought their free cash flows would grow about 20% for the next 4 years, then 2.5% after that. I do think that's a reasonable estimate based off of the company's plans and all the money they're investing into their business. Simply Wall Street is a little higher than me. They're at $320 a share, so they're saying the stock is 49% undervalued. 14 analysts priced this stock and the average price target was $288. So we're all in the same range. We're all saying the stock is really undervalued. This is where the stock has been trading since it IPO'd. So it did really well for 13 years. And then in 2018 and 19, it dropped a lot. And then it traded sideways in 2020. And it peaked at $350 a share back in February. But it's been more than cut in half since then. This is where the stock has been trading the past 12 months. So for the first 6 months on this chart, the stock went way up and then it came way down. The stock is up about 30% in the past 12 months, but it was up a ton just a few months ago. So if you bought the stock up here, you'd be crying right now, but I'm sure it's going to come back up to this point, probably a lot higher. It's just hard to know when. So the stock pretty much moves with the market. It has a beta of 1. The stock has gone up similar to the S&P 500, about 32%. In the past 52 weeks, the low was 116, the high was 355, and the stock is trading below its 50-day and 200-day moving average. Over 5 million shares are traded each day on this stock. Of the 348 million shares outstanding, 269 million are on float. 63% are held by institutions, and 2% of the shares are shorted. In the past year, 3 years, and 5 years, this stock has done much worse than its industry, and it's done worse than the market. If we looked at this stock just 6 months ago, these numbers would have been totally different. Analysts are forecasting their earnings to decrease 18% and their revenue to increase 13%. In the past 5 years, their annual earnings decreased 6%, but in the past year, it's up 2,000%. It's probably because of that other income and expense item. If you invested $10,000 into this company 10 years ago, you'd be at $13,000 today. That's only a 2.4% annual return. The founder and CEO of the company owns 20% of the stock. These shares are the ones that are not on float. They're not available for investors like me and you to purchase. BlackRock owns 4%, then Vanguard, PrimeCap, and Jane Street Group. Let's look at their financial ratios. A lot of these Chinese companies have amazing price multiples. They have a PE below 8, that's a really good PE ratio. Their price to sales is 3.4, that's also pretty good. And they have a good price to book ratio of 1.7. So if you're a big fan of price multiples, then this stock is really undervalued. They have a good return on invested capital of 10.5%, which is higher than its WACC. They can cover their interest payments 5.5 times, a high ROE at 21%. Their current ratio and quick ratio are 3. And they do have a ton of cash on their balance sheet, 162 billion yuan. That's equal to 24 billion US dollars. Their market cap is $57 billion. So 43% of their market cap they have in cash. I wonder if there's another company that has as much cash as a percent of their market cap. Let me know in the comments if you could find a company that's higher than 43%. So the way to calculate it, you take the cash on their most recent balance sheet and divide by the market cap. Imagine there was a big sell-off again in Chinese stocks and the stock got pushed down to $20 billion. That means the company has more cash on their balance sheet than it's worth, which just boggles the mind thinking about it. Because they have more than just cash on the balance sheet, they also have a search engine with over 1 billion people going to and 200 million people visiting its streaming app. So there's a lot of value there. So just to imagine that the cash on a balance sheet can make up so much of the worth of this company. If this stock was identical in the United States, the same financials, the same information, it would be $1 trillion company. But instead, it's traded in China and the market cap is under 100 billion. The company is well capitalized. They generated over $3 billion of free cash flow in the trailing 12 months and have almost 19 billion of working capital. So they have almost $22 billion of excess funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 17 companies in the same industry as Baidu. And if Baidu has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're much better in all the price multiples. Their current ratio is fine. A lot of companies in this industry have negative earnings. They're positive. They're a little lower in debt than the average company. And they are smaller than the average company just because Google and Facebook are in this industry and they drag the average up so much. So to summarize, I have them trading at a 45% discount. And this stock seems really undervalued. But that doesn't mean the stock price will go up. There's a lot of fear that the Chinese government can interfere with this company. But I personally would invest in this company, and I'm not concerned with the geopolitical risks. Because even though China is a communist country, they still want to make money. Every country needs money to grow its infrastructure and to grow its economy. Plus, they have so many people visiting their website. That's such a huge asset. Google's market cap is 24 times Baidu. That just shows you how undervalued this company is because it's in China. I rank their free cash flows 8 out of 10, their revenue 7 out of 10, and their ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.